You did everything right. You got pre-approved. The letter said up to $320,000. You found the house. You made the offer. The sellers accepted. And then, 11 days before closing, your loan officer calls. The tone is different this time. The underwriter has questions. A week later, the answer comes back. Denied. You are standing in a house you already told your family you bought, holding a pre-approval letter that turned out to mean less than you thought. I worked the branch for over 20 years, including approximately 10 as a branch manager and district manager. I watched this happen to good, careful people who did nothing obviously wrong. And almost every time, the reason was something nobody had explained to them. So let me explain it now. Here is exactly why a pre-approval falls apart, what the underwriter is actually looking at, and the simple moves that keep your loan alive from offer to keys. Quick disclaimer. This video is for educational and informational purposes only. It is not legal, financial, or tax advice. The stories I share are based on real experiences from my over 20 years in banking, including approximately 10 as a branch manager and district manager. Details have been changed to protect privacy. No real customers are named. The narrator is anonymous. AI tools are used to produce this content. Rates, fees, lending rules, and policies vary by lender and change over time. Always verify with your own lender before making financial decisions. Start with the part almost nobody is told clearly. A pre-approval is not a loan. It is a conditional yes. The Consumer Financial Protection Bureau says it plainly. A pre-approval letter is based on assumptions, and it is not a guaranteed loan offer. Read that again. Based on assumptions. When you got pre-approved, the lender looked at a snapshot, your income that week, your debts that week, your credit that week. They did a hard credit pull and reviewed your pay stubs, and then they wrote a letter that says, if everything stays exactly like this, we expect to lend you this much. The letter is real. It is useful. Sellers take it seriously, but it is a photograph, not a contract. The actual loan does not exist yet. It gets built later by a different person in a process called underwriting, and the underwriter does not work from the photograph. They work from what is true on the day they look. Here is where many people get hurt before they even start. The words prequalification and pre-approval are not protected terms. The Consumer Financial Protection Bureau states that lenders use these two words differently, and that some lenders issue one based on unverified information you simply told them, and the other based on documents they actually checked. So two buyers can both walk around saying they are pre-approved and be holding completely different things. One had their pay stubs, tax returns, and bank statements reviewed. The other typed some numbers into a website and got a letter back in 4 minutes. Both letters look official. Only one of them has been pressure tested. If you are not certain which one you have, that is the single most important question to ask your loan officer this week. Ask them directly. Was my income verified with documents? Was my credit pulled? Is this a full pre-approval or an estimate? The answer tells you how much weight your letter can actually carry. Now the part that catches the most careful people. The weeks between your pre-approval and your closing have a name inside the industry. Lenders call it the quiet period. And the reason it has a name is that this is the window where loans quietly die. Here is what most buyers do not know. The lender does not just check your credit once. They pull it at the start, and then they pull it again, usually 1 to 10 days before closing. That second look is a soft pull, sometimes called a credit refresh or a gap report. It does not hurt your score, but it is not a formality. The underwriter is looking for one thing. Did anything change? New debt, a new credit card, a car loan, a late payment, a new inquiry they have to ask about. If your financial picture moved between the photograph and the closing table, the loan you were promised may no longer be the loan you qualify for. The quiet period is not quiet. It is the most important stretch of the whole process. Reason number 1, and the one I saw most often: new debt during the quiet period. A family gets pre-approved. They are excited. The house is empty and it needs a couch, a bed, a refrigerator. So they finance the furniture because the store offered 0% for a year and it felt free. Or they buy a car because their old one finally died and the timing seemed fine. It was not free. It was not fine. Every new monthly payment you take on gets added to your debts. And when the underwriter recalculates, that new payment pushes one number higher. We will get to that number in a minute. I watched a couple lose a house over a bedroom set, not a car, a bedroom set. Financed 6 days before closing. The furniture could have waited 3 weeks. The house could not. The rule for the quiet period is simple. Do not open new credit. Do not finance anything. Do not even apply. If a salesperson runs your credit, that inquiry alone makes the underwriter stop and ask what it was for. Buy the couch after you have the keys. Reason number 2, a change in your income or your job. Lenders want to see stable, predictable earning. Most loan programs want roughly a 2-year history of steady income. And here is the part that surprises people. The lender verifies your employment again late in the process, sometimes the same week as closing. They may literally call your employer to confirm you still work there. So the dream job offer that arrives mid-process is dangerous timing. A new job, even a better paying one, can pause or sink the loan because you no longer have history at it. Switching from salary to commission, going from employee to self-employed, dropping hours, starting a probationary period. All of these change how an underwriter reads your income, and not in your favor, no matter how the change feels in your real life. This one feels deeply unfair, and I understand why, but the fix is timing. If you can possibly help it, do not change anything about how you earn money between your offer and your keys. Hand in your notice the week after you close, not the week before. Reason number 3, and this is the number everything else feeds into, your debt-to-income ratio. It sounds technical. It is actually simple. Add up everything you must pay each month: car payment, credit card minimums, student loans, and the new mortgage payment itself. Divide that by your monthly income before taxes. That percentage is your debt-to-income ratio, your DTI. The underwriter cares about this number more than almost anything else. As a rough guide, conventional loans often want your total debts under about 45% of your income, and FHA loans often look for around 43%, with room to go higher if you have strong savings or great credit. Lenders set their own limits, so the exact ceiling varies. But here's the trap. When you financed the couch in reason 1, your DTI went up. When your hours dropped in reason 2, your DTI went up because the income side got smaller. Reasons 1 and 2 do not just cause problems on their own. They cause problems by quietly pushing this one number past the line. Protect the DTI and you protect the loan. A few smaller things underwriters catch that are worth knowing. Large deposits you cannot explain. If $4,200 suddenly lands in your account, the underwriter has to ask where it came from. They are not being nosy. They are required to confirm it is not a secret loan. Even a genuine gift from family needs a short letter saying it is a gift and does not have to be paid back. So keep a paper trail on every large deposit. Next, the appraisal. If the home appraises for less than you agreed to pay, the lender will only lend against the lower value, and that gap becomes your problem to solve. And finally, undisclosed debts. If you forgot to mention a co-signed loan or a child support obligation, the quality control check will find it, and a surprise looks worse than a disclosure. The theme across all of these is the same. Underwriters do not like surprises. Anything you can explain in advance is manageable. Anything they discover on their own becomes a question, and questions cost time you may not have. So, here is the playbook. The whole thing in one place. Before you even make an offer, ask your lender the question from earlier. Is this a verified pre-approval or an estimate? Get the honest answer. If it is only an estimate, ask what it takes to get fully underwritten before you shop, because some lenders will do exactly that, and a fully underwritten pre-approval is the strongest letter you can carry. Then, from the day you make your offer until the day you hold the keys, treat your finances like they are frozen. No new credit, no new loans, no financing the furniture, no car, no applying for anything, even if it is free, even if it is approved instantly. Do not change your job or how you get paid. Keep every bill current. Keep a written record of any large deposit, and stay in close contact with your loan officer. Tell them before anything changes, not after. A good loan officer can work around a problem they see coming. Nobody can fix the one that already happened. Somewhere right now, a family is celebrating a pre-approval letter telling relatives they bought a house, already picturing the furniture in the rooms, and most of them will be fine, but some of them will finance that furniture next week and never connect it to the phone call that comes 11 days before closing. That is the whole problem in one sentence. The danger never looks like danger. It looks like a couch. It looks like a better job. It looks like good news. A pre-approval is not the finish line. It is the starting line. It is the lender saying, based on this snapshot, we expect to lend to you. Now do not move. The buyers who make it to the keys are not lucky and they are not richer. They are simply the ones who understood that the quiet period was the real test, and they held still through it. You got pre-approved. Good. Now protect it. Freeze your finances, keep your loan officer close, and buy the couch after you have the keys. If this helped you see the mortgage process more clearly, hit subscribe. I drop new Banker Insider videos on a regular schedule, and the comments below are where I answer specific questions from over 20 years at the branch. Drop yours, and I will get to it. I will see you in the next video.